Good afternoon. It is 2:46 on Friday, the 26th of July 2024, and we've completed 2 years and 16 weeks of this roughly 8-year fire journey. Just having a look at the market as you see it here, and we can see that there has been a little bit of a pullback in recent days. I'm just trying to make sense of where the line actually is. I think it's here. So the pullback today actually has been minimal. It's not even 0.1%, but obviously in the days preceding we've seen a bit more of a pullback than that. Let me just switch the scale here a little bit, just to try to see when if I can figure out when that happened. I'm just trying to sort of get a better understanding of what we're looking at, if that makes sense. Arguably, if anything, I've just messed everything up here, but okay, so as I say, this is the 26th of July. Just looking at the dates on the bottom there. Okay, so if I pull this way a bit, no, I can't really, can I? I forgot what scale that was there. Let's try. Okay, so that's 1 month, 5 days. 5 days probably will give us a better idea. So looking at the dates on the bottom, okay, so 26th starts about there. So basically little change today, but as you can see, this is the 23rd up about here. So from the 23rd, which would have been what, Tuesday? Let me just double check that. Yeah, 23rd was Tuesday, so we've had a bit of a drop from Tuesday, and basically right up until yesterday, Tuesday to Thursday, there has been a little bit of a drop, and we've been kind of holding steady since that, or at least near enough. Right, just trying to get this back to our normal view at the minute, which could prove to be a bit more of a challenge than I would like, perhaps. Let's just see. Okay, that actually doesn't look too far out. Right, let's just have a look at the notifications as things stand. I saw this one pop up as I was trying to do that there. 3M up 13%, following stellar earnings and raised full year outlook. I'm not going to comment on that. Dexcom down 39%, lowering full year revenue guidance after quarterly miss. Coursera jumps 24% as Q2 earnings and revenue beat expectations. Capgemini falls 9% as revenue forecast turns negative amid weaker North American market. NatWest Group up 7% after raising its 2024 profit forecast and hiking dividends. Biggest stocks before earnings: T. Rowe Price, Bristol Myers Squibb, 3M, Colgate Palmolive, L3 Harris Technologies, Dexcom. New York Community Bancorp falls 16% on higher Q2 loss and multi-family loan exposure. Ford Motor down 13% on underwhelming earnings amid higher warranty costs. Kering down 7.5% to a 7-year low in response to weak sales in China. Stellantis plunges 9% as first half net profit nearly halves amid weak US sales. Another biggest stocks before earnings: IBM, AbbVie, Ford Motor, RTX, American Airlines, QuantumScape. Visa down 4% on underwhelming revenue as higher borrowing costs limit spending. Meta Platforms down 3% after debuting a free version of its Llama AI model. Alphabet slides 5% as weaker YouTube ad revenue and AI losses weigh on a strong quarter. Deutsche Bank down 5.5% after posting its first quarterly loss in 4 years. Tesla down 7% on earnings miss amid EV discounts and AI spending. And then, as you can see, we've got our previous purchase prices shown there. So looking at that, we were last live, or I was last live 11 days ago. So it's been, a bit over a week. And actually, interestingly, if you look back 2 and a bit weeks, the share price was even higher then. So it has come back a fair bit. Where are we sitting at the minute? Let's just have a look here. The 82.28.50, that was 3 weeks ago. 82.28 was 3 weeks ago. And currently we're sitting at 80.23. 80.23 currently. Let's go back in there. I just want to see roughly how long ago it was since we were last at that kind of level. So there's a couple of 81s, a 79. Okay, so somewhere, that was about a month ago, somewhere in the last month, we crossed the threshold from £79 a share to over 80. But we are seeing the market back down at the £80 a share at present. That means we're going to be able to dollar cost average a little bit. But before I go ahead and do our weekly investment, let's just have a look at the figures. So currently we've got 215.5 shares worth a little over 17,000, so 17,285 as things stand. The return on investment is near enough 20%, and the average purchase price to date, 66.81.92. So we'll see that jump up the ways because we're still in profit nonetheless. And with that said, remember 66.81. Okay. We'll see where that goes to. So I'm going to put in our weekly £120 worth of theoretical money into the Trading 212 practice platform, using the Vanguard S&P 500 exchange traded fund, and we're going to be able to buy roughly 1.5 shares with that. It's going to be a market buy. I'm sending it through now. We should see there's the execution. So 80.21 is what we got it for. and you can see the price here. The average purchase price has gone up to 66.91, and the return on investment has dropped a little bit. I think that probably has more to do with the change in the price, to be honest, than it does with the investment that I've just made, because the market is open. So yeah, the figures have updated obviously because the portfolio value now is just over 17,400, and yeah, that's basically it for now. The free shares offer that was previously running has closed, so there's no free shares to be had just at this moment in time. Actually, with that said, let me just throw this up on screen because I wanted to have a little look, see if I could figure out what would happen, or how long would it take effectively to reach financial independence. If you basically invested £25,000 and just left it there in the S&P 500. I was just trying to figure out, is it something that would be a feasible thing to do? So let's say, for instance, if you had a child that was just about to start in the world of work, would it be a sensible or a feasible thing to do to set them up with a 25,000 investment in the S&P 500, and if it was left there for long enough, would they be able to declare financial independence as a result of that? So let's have a look and see what I did. In fact, you know what I'm going to do? I'm going to delete this, and I'm going to delete that, but I'll leave the headings and I'll leave the years, okay, because I want people to see how this is done. And basically this is kind of how I go about making my own predictions, calculations, whatever you want to call it, for where I think the market should be as regards my own portfolio. So if you look into the history of the S&P 500, historically it has produced a better than 10% per year return on average when you look at it over a 20, 30, 40 year period. Now I have also heard people say that the true figure is more like 7%. And they say that that's because they're accounting for inflation. So that may be a relevant thing to take into account. However, at the same time, I would argue that yes, over time prices will change, but the figures basically are the figures, if that makes sense. I'm not saying what you can buy with these figures at that time. I'm just saying that that is, you know, where the calculation takes you basically. So as you can see, I've said that we're starting with an initial 25,000 deposit. Let me make this bigger actually, because I still don't think you can see it right. And I want to freeze the frame. I wonder, can I do that? Let me see. So I want to freeze the frame, and I do that by doing what? I think it's data, is it? Or is it view? Must be view, perhaps. Freeze panes, that's what I meant to do. Freeze panes. Right, okay. So, now that we have frozen the panes, hopefully... Okay. Right, so we've got our titles up at the top here. So as you can see, we are saying year one, we're having an initial investment of 25,000. We are going to assume 10% growth. So this column is just going to calculate that 10%. So I'm going to say that that equals the initial amount times 0.1. or 10%. And when you hit enter, obviously that gives you 2,500. Okay. Then to calculate the new total value of the investment, we say that that equals the initial investment plus the 10% assumed growth, which gives us 27,500. Okay. And then to calculate that in the following year, we're going to say that the sort of the initial amount at the start of year two is going to be the same as the total from last year. So that's the 27.5. And then we can simply copy the formula down for the 10% thing. So that gives us 2,750. And likewise for the total value, it's just a matter of adding those two together. And that gives us that figure there. So now that we've got that amount of the sheet set up, we can just select those three columns and fill them down to the bottom. So I've done this looking at a 30-year period, and perhaps one way to look at this is if you had somebody that was starting out in the world of work at 20 years of age, then if they had this initial investment when they were 20 and it was allowed to run for 30 years, so they would be 50 at that time, hypothetically speaking, they would end up with a portfolio value of a little under, it's quite a bit under 500,000, but a little over 400,000, let's say. Assuming that the market does what the market tends to do. Now, in terms of what can you do with that kind of a portfolio value, well, let's have a look at what's known as the safe withdrawal rate, which is basically 4% of the total value of the portfolio per year. So, in order to figure out what the safe withdrawal rate would be in any particular year, we say it is the total value, so that's that one, multiplied by 4%, which is also represented as 0.04. Pardon me. So, in theory, at the end of the first year, you would only be able to pull out £1,100, and that's per year. So not enough to live on. From that initial 25,000 invested. Now, if you wanted to know what that equates to per month, let's say that's equal then to the yearly amount divided by 12. So not even £100 a month, 91.67 roughly, is the amount that you could take out per month without basically ruining the value of the portfolio. Right, what I want to do, I want to fill down these two columns for the full 30 years, just to let you see what it actually looks like. Okay, so as I say, after the first year you can't even take out £100 a month. However, after, let's have a look at 10 years, there's 10 years. So after 10 years the portfolio value is sitting at around about 65,000, and that should mean that you should be able to use about £200 a month out of the portfolio without depleting it, or 2,500 per year. If we look at it after 20 years, the portfolio value at that time is in around 168,000, and that means that you could take out roughly £560 a month without depleting the portfolio. Now, $560 a month doesn't sound like an awful lot, but I would suggest that it should be enough to provide food for a small family. Now, it may not cover other bills and things like that, but that should be enough to, to actually get the bare necessities with. So we're kind of, at 20 years, we're starting to get into serious sums. Now, let's look at 25 years just to see the difference. So if you remember, at 20 years, the portfolio value was 168,000, and at 25 years it is 270,000. But whereas before you could only take out 560 a month, now at 25 years you can take out 900 a month. Now, personally speaking, as far as I can tell, when my mortgage is completely repaid, which I'm hoping will be in the not too distant future, £900 a month actually should be sufficient to live off. So hypothetically speaking, at 25 years further down the line from having had 25,000 invested, hypothetically I could have been financially independent. That would have been at roughly age 45, so just a couple of years ago for me. It's all hypothetical though, because that isn't the case. I didn't have £25,000 sitting in the S&P 500 waiting for me. But what I like about this is that although this is a hypothetical calculation, it does show you that in theory, if you had a significant amount of money invested and left it invested for long enough, you can actually, your kids can actually reach a point where they can access serious money without having to actually invest for themselves, if you see what I mean. So let's take the figure at 30 years. So this is 30 years after having had an initial 25,000 invested in the S&P 500, assuming 10% growth per year. And at that point, the portfolio value is this sorry, yeah, 436,000. Which basically, using the safe withdrawal rate of 4% means that you can safely withdraw 17,000 per year, or roughly 1,400 per month. Now, once you start getting into these kind of figures, in fact, I would say once you are hitting over, I think it's over 12,000, then you begin to have to pay income tax. So these final figures here, I believe, will all be subject to income tax, whereas the ones before, I don't believe they actually are. But anyway, don't take my word for that. Always consult a qualified professional, which I am not. But I just thought I would like to let you see that little calculation. As I say, that is just basically what some people might refer to as coast fire, where basically you start off with an initial 25,000 investment. You don't touch it other than to allow it to benefit from I forget what it's called. There's basically a cumulative it's basically cumulative interest, but it's the dividends as well. And when the dividends are reinvested and the cumulative effect works on the portfolio, after 30 years, you're sitting with an amount of a little bit over 400,000. So it's a significant increase in value compared to that initial 25,000. I mean, let's actually just calculate how many times that has doubled. So basically, if we divide the total portfolio value by 25,000, that will tell us how, what multiple. So there you go. It's 17 times more, almost 17.5, but not quite. Almost 17.5 times more than the original portfolio value. So it really does show you the benefit of cumulative interest. Right, that's it for today. Thanks for watching if you have been. If you particularly enjoy this video, give it a thumbs up. If you're interested in following the journey, consider subscribing to the channel. And apart from that, I'll be back again at some point next week with more. I actually forgot to throw up the little screen for the end there. There it is. So yeah, as I say, back again next week. Have a good weekend, and see you then. Thanks for watching.